Okay, so I think I'm going to get started. We are going to record the webinar, so those people who do come in a bit late, you can always get access to that at a later stage. So firstly, I'd like to introduce myself. My name is Julian Allen. I'm the Head of Sales at FP Markets. It brings me great pleasure today to welcome you all to this education series on technical analysis that will be presented by Gary Burton. A little bit about our business. Our direct market access model sees our interests align with our clients, and our company will never profit from your losses, which is something that's very important to us. This is why we dedicate resources to providing the very best in education and trading tools to give our clients the edge that they need when they are trading. With this, I'd like to welcome everyone to this unique event. It is great to see so many people here. And this is a bit of a teaser for the full day workshop and then also some follow-up webinars on more specific topics. And this is going to cover the many facets of technical analysis. With regard to the workshop, we will send an email out which will confirm the details, but it is a full day session that will be held on the 5th. Gary will fill you out with more information on this towards the end of his presentation. So a little bit about Gary. He's had over 10 years experience as a certified technician and has experience to back this, having worked on the desk at Macquarie and RBS over the last 6 years. So just a little bit of housekeeping before we proceed. I'd just like to show you the disclaimer. The main point here is that this is education material and it is prepared for general guidance only and does not constitute financial product advice. So I think I've done enough speaking. I'm going to hand you over to Gary to provide his incredible insights into technical analysis and how this can be used to equip you to trade the financial markets. Thank you.
Okay. So welcome again, everyone. Julian's done a bit of an introduction there. I'm just going to go through very quickly the same thing. I'm the Director of the Australian School of Technical Analysis. You'll find us on the web under www.theaustralianschooloftechnicalanalysis. We run specialised workshops in technical analysis and some of the subjects around there, as in the Candlestick Masterclass and a few other things. So today I'm going to do a very quick introductory session on the entry-level technical analysis. As Julian said, we're offering a full-day workshop. It's a no-hold-barred workshop where it doesn't matter at what level of trading you're at, everyone will come away with something. So that the workshop is suitable for every type of trader, specifically those interested in equities, equity CFDs and FX. A lot of interest in FX these days. And I'll have, as we go through today, I'll have a little bit of a look at that on some charts there. So today we're going to cover the basics in technical analysis that every trader should understand. So I understand there's people of all levels of knowledge in this area. I don't think you can ever understand too much about it. So I'm going to start at the start with today's presentation and go from there. So in the world of analysis, there's been, as a bit of a summary, I don't need to remind people of this, there's been a lot of turmoil over the last few years, which has disrupted a lot of retail trading and a lot of investment themes. This is, we'll take a look at this based on this model here. This is the basis of when you come at the markets from a technical perspective. We have this model that Dow put forward 100 odd years ago. It's still very, very valid today. It is still used in declaring bull markets and bear markets based on some of the methodologies that we'll go through today. So we put forward that bull markets and bear markets run for 3 to 5 years at a time, and we determine the relationship of the averages to past data. So we're looking at past data to create a view about where we might be at any particular time, and this is the basic assumption used in all technical analysis. We often bring in indicators and various other things to confirm what we're seeing. which can be quite dangerous at times, because if we've got particularly if we have a position, we're looking for things to confirm what we want to see, not what's really happening. So I have a very price-based view of the market, very little use of indicators, but a very price-based view of the market. So we take a look at technical analysis. It's not a complex subject, and often traders make it more complex than it needs to be and often miss what's really happening with the price. Now, some of this is based on psychology. I fully agree with that. That's in the first part of the full-day workshop that we're offering. We're going to deal with the trader's mindset. The very first session, it'll take about 10 or 15 minutes, and we will deal with the psychology of loss and easily demonstrate how this stops us from progressing into the next trade. Now, those who have been trading for a while will certainly understand that when things don't go our way in a trade or a position, we often go to a place that is not very conducive to where the real market is or what's really happening in the market that we really need to see and get on with our trading. So I have this very, very strong view that the trading side of this is a business. It's not a hobby. A lot of people put forward that this is a bit of a hobby. It's not. It's actually a business and needs to be treated as that. So in our approach to the markets, we have this model, this bull market model of buying, the initial buying in the bull market, and the technical buying where things are moving along nicely, and then we get the speculation top where you start to get your tips off your cab driver and various other things. And there's a loss of hope as leverage runs out. There's a loss of hope of the market going any higher. Things are starting to come in. And if you look back at the turmoil over the last 7 or 8 years, it was certainly a leverage issue that brought the top of the market in, and then comes into technical selling and then ultimately distress selling. Now, this occurs even in the minutest time frames when we start to drill down into our time frames of daily and intraday, hourly type of charts. This type of pattern also occurs. This model that we're going to look at today is something that all other methodologies are based on. It's your Elliott wave and various other esoteric methods are based on this model. If anybody's read Elliott's books or Elliott's notes, then he refers back to this Dow theory model. So when we look inside the markets, when we take a closer look at our charts, we notice that the markets move in impulse moves, or what I call a primary move, and which gets underway, and then we go into these secondary areas which can last for 3 weeks to many months. These are the areas of consolidation. These are the areas that set up patterns in our charts that we can work from until ultimately the primary move is back on again. Now, this of course works in reverse and on the downside of the markets as well. But markets have a primary move underway, they go to a secondary move from time to time, and then a primary move gets underway in there. So it's not a precise outcome, of course, and it depends on many factors, both fundamental and the technicals, with fear and greed and percentage buying and selling. When you apply this to a chart, this is the backbone of the workshop I'll be conducting will be based in time frame trading. So we're going to look at the same thing over several time frames. This is an example of that. In this chart of the index at the moment, this is fairly recent. You'll notice that we had a low, major low back here. This is the little bit of distress down there as the market sold off into June, July. And then finally we come out of the market in what's called a primary move. And these very large trading periods in here, what the first thing we need to observe when we start to step up to our charting is where is the primary move in this stock or in this currency or in this futures contract or whatever we're looking at. So we look from the left-hand side across. We had a very strong primary move down, which resulted in this consolidation of the base here, June, July. And then out of that, we had a very strong primary move upwards, and the market got underway and formed a series of higher highs and higher lows. So we've got the high up here, at a bit over 5,400 points. Came back, the market retraced back into a low, which was a higher low than the previous one. We formed a smaller lower high here, and then the higher low again, and then broke again into 5,400. Now this is really the bit that sets our trend, or gives us the direction of our market. You'll notice that the big moves up on this end of the chart, the big moves are up in here. This is the stamp of a bullish move underway, and the markets get underway. As you know, the last few weeks we've had several weeks of consolidation, and so we've now got this secondary market forming in our index. Now, secondary market is not a reversal pattern. The secondary market is just the consolidation area where we get to work out, based on our information that's in the background, we get to work out where our next move is going to be. So based on this information, then the short trade would have a limited outcome, because the ultimate trend is up. This is a weekly time frame. The ultimate trend is up. When we drill down a bit closer to this, if we take a look at this April, May, June period in here, this last few weeks of the weekly chart, we come in here to the daily chart, and we can see again in here that it's formed a low, a high, and a higher low, and a higher high, and then went into this secondary move in here, broke down into and ultimately formed a higher low again. So it hasn't set a downtrend in place, it's just formed a higher low, went to another high, and recently has come back in here to this consolidation. Last week we had a very strong push upwards, and we've had a secondary move, a secondary consolidation again, which the market often takes just to work out where it's really going. So again, we have in this right-hand side here, we could actually argue that there's been a high, a low, a lower high, and a lower low. So in that scenario, we actually have a downtrend in that very short time frame. Whereas in our weekly chart, I'll go back to the weekly chart up in here. Ultimately, our weekly chart is only showing an uptrend, but against that uptrend in this last few weeks here, we've had a daily downtrend. So our thinking from a trading perspective is that we're looking for the impulse move again to trade, for the markets to trade higher in line with our larger time frame. So if we drill down again into this is a daily chart that we're looking at here. If we drill down again into the last couple of weeks, we come into this intraday hourly chart, and again you can see the very strong moves, the very primary moves upwards here on the left-hand side, and the little secondary markets come in with a primary move and a secondary market in here, and a primary move again, and then we had a very strong move down, starting to set lower highs and lower lows, and lower highs and lower lows inside on an intraday basis. Primary move again up here, and lower highs and lower lows. The little secondary markets come in. They give us information about where the next move would be based on the history behind it. And in this case, with markets broken down back into this 53.80 area. Again, consolidation in here, a really interesting pattern with the vertical wall down, and out of that consolidation, that W pattern, we've got this vertical wall up, and so it's set our next direction. We have the higher low, and the equal high and the higher low. So as of yesterday, this was taken yesterday, there's a very high probability that we're going higher based on this higher low. So it sets out our trading. As traders using analysis, we need to develop out a trading plan that suits us. This type of information or this type of view of the market will help you put together a trading plan. Trading plans are different for everyone. Everyone's interested in different things. There's no right or wrong trading plans. The interesting thing is you just need to understand which trading plan you're working to. So if we look at some of the markets involved with this, currently, if we look at stocks, in fact, I'll go to the Dow first. A lot of interest in what's occurring in the US markets. This is a weekly chart of the Dow here. You can see that, again, it's had very strong moves upwards. It's trending upwards. It's officially, in fact, in 2011, it officially went to a bull market. consolidation here and consolidation recently with this ascending triangle. There's been a very strong ascending triangle here, and the last couple of weeks it has broken out of the top of that triangle. So the only argument for this particular index is that you would be looking potentially for this to go higher. When you drill down into the right-hand side, of this chart with our candles here, we've broken above this resistance. As an analyst, we're looking for a further move up, and this has been quite interesting that we've had the break, we've had the retest, and now we've got the move underway again. And this week so far, and I'll go into this a little bit in the workshop in this candlestick analysis, the interesting thing about this week, the trigger for this week will be whether this closing area here is above the midpoint of last week's candle, which is sitting right there at the moment. So it's at this kind of decision area with this. Now, if we take also a look here at one of the Australian stocks, BlueScope Steel. In here, this recently, you'll notice back in the chart, at first observation as an analyst, we're looking for the primary move. It's the daily chart of BlueScope, primary move. These are the secondary markets. They take time to unfold. In our model, they can take 3 weeks to many months to unfold, and the primary move again, the secondary market, and then the primary move out of there. BlueScope, in a daily basis, has trended down recently, and a very strong downward move there, which set the chart a little lower. And you notice in here, as of now, BlueScope's setting this little secondary market in here with quite a move out of the low, sitting on the support around here at $5.34. So this is the type of thing that we go to with inside the workshop. We'll go into this in quite a bit of detail into the, I'll just bring it out again, into looking at these daily movements and the shape of the candles, particularly in the weekly charts. We'll look at the shape of the candles in the weekly charts. We'll get BlueScope up on this weekly basis and get all this off here. And you'll notice that based on our model, BlueScope is actually still trending up. Weekly chart is still trending up. So we're looking for the long trade rather than the short trade in this. So the workshop is based around this price analysis of the markets. We get in there and drill in there. There's a full set of notes provided before you come into the workshop. I would ask that you even review this webinar and just this very simple model of price analysis of higher highs and higher lows, higher highs and higher lows and higher highs, higher lows, and then the high, and then we have this move downwards here. There's a called a corrective move. We'll deal with that in our education on the day as well. So our webinar, as part of this webinar, I also there's been a lot of interest in Ichimoku, in the Ichimoku indicator. Somewhere down the track we will run a special class on it, but for today, because you've logged in for today, I'll do a very quick presentation on Ichimoku and then come back to our workshop series. So Ichimoku is a method that's gaining a little bit of interest around the world. It's been around for a long time. Most charting packages have it in there. There's nothing, there's no charge, no one charges anything for it. It's just a basic indicator. But there is a little bit, it looks quite messy on the chart, and there is a little bit just to clear up about what it actually does. And Ichimoku is essentially a support and resistance trading method. So we're quite interested in support and resistance from a technical analysis point of view. So the Ichimoku system is composed of 5 elements that were developed to show support and resistance. That's all it does. It shows support and resistance using 5 different elements. So the first part of Ichimoku, I'm going to go through this very quickly. there's some very good books on this subject around. But the first part of Ichimoku is this Chicago span, or the purple line here will refer to the colors. The purple line here, it is simply the closing price, the current closing price, shifted back 26 periods. And what that does is gives you at a glance, gives you a view about where the current closing price is in relation to the past 26 periods of price action. So in this case, the closing price out here on the right hand side is simply shifted back 26 periods and shows up on the chart here. You notice that the low on the red candle here shifted back has formed this Chicago point back in here. So that's all it does. It just follows the price, the closing price, shifted back 26 periods. So the Chicago pan is the current closing price shifted back 26 periods. This allows the trader to see at a glance if the current price is above or below 26 periods ago. The Chicago span represents the closing price. It also represents past support and resistance levels. Now there's a little bit in that which I won't go in today. It's bullish if the Chicago span is above the price, it's bearish if the Chicago span is below the price, and it's neutral if the Chicago span is trapped in the price, if it's traveling in the price. So back in this area, back in here, the Chicago span was in our price as the market was consolidating here on the right hand side, and as the market moves out, our Chicago span follows that out into price. So we can see immediately that the price is trading higher than it was 26 periods ago. The Tenkan-sen line, the red line on the Ichimoku indicator, is the highest and lowest price of the last 9 periods divided by 2. It's very important to mention that Ichimoku has nothing to do with moving averages. I've heard talks on Ichimoku and trying to relate it to even moving averages. It is not a moving average based system. A moving average based system is based on the closing price. Ichimoku, the Tenkan-sen and Kijun-sen and the other lines are based on range, and in Japanese methodology, range is very, very important. It encompasses all of the buyers and sellers in the market. So that took part in that part of the market. So the Tenkan-sen is the highest and lowest price over the past 9 periods divided by 2, and it shows up here. If we count back, this is our high period here and our low period down here, 9 bars, and it works out to be in the middle of that range. And as the price moves forward, the Tenkan-sen moves forward with the price. So that's all it is, highest, lowest over 9 periods divided by 2. The first level of support and resistance. So you'll notice that when you overlay this chart, you'll notice that often in a very bullish market, price will respect the Tenkan-sen line and continually trade above it, come back and test it every now and again. But that's a very, very good sign. The Dow chart that we looked at earlier, the Tenkan-sen line, has been an incredible support on the movements of the Dow over the last few years. So the Tenkan-sen and the Kijun-sen measure the short-term trend and short-term support. The Tenkan-sen is following the price indicates the trend is strong. The Tenkan-sen is flat. The price is consolidating or not trending. And the first observation of Tenkan-sen is if the line is above or below the Kijun-sen. Kijun-sen is the green line, and the Kijun-sen is the highest and lowest price over the past 26 periods divided by 2. So it takes the high price again, takes the low price again, and divides it by 2 and plots it onto the chart. So we can see here that the Tenkan-sen is above the Kijun-sen, quite a bullish move through here. Chicago span is out here in fresh air. So it's quite a bullish move underway, and as the markets consolidate in the right hand side here, they flatten out to provide support. In this case, a bullish move support. If the market was trending down, you'd be looking at them as resistance in there. Then we have the future cloud. The future cloud is plotted 26 periods forward. It's shifted forward on the chart. Most charting packages are able to do this. It is simply shifted forward, and again it comprises 2 elements. And the yellow line and the black line, or the A and the B line, in there, the Senko span A is the Tenkan-sen and the Kijun-sen divided by 2, and then shifted 26 periods into the future. So it gives a reference to price 26 periods into the future. So the value of this line here is the two of these values divided by 2 and shifted forward onto the chart. The yellow line, this is the most important line in the cloud, is Senkou span B, the highest and lowest price of the past 52 periods, and then divided by 2 is shifted 26 periods into the future. This gives you a sign of future support and resistance in the market. And we notice this chart here, all of the elements are trading above the cloud. This is very bullish. This is the type of thing that we would look for. There's a whole methodology of trading around Ichimoku cloud, but essentially these are the elements, this is the way they work, and we look purely at the market as support and resistance. In this case, you'll see that the Tenkan-sen line is providing nice support through here, and occasionally it will come back and test the green line, and occasionally price will come back into the cloud, which is a observation of its own. So Ichimoku and multiple time frame analysis, the bottom line is that high probability of trades occur when the price finds support and resistance in multiple time frames on different elements of Ichimoku. The direction and length of trend need to be considered for higher probability outcomes. So we'll run a specialized class on this sometime in the future. If you monitor the emails from First Prudential. And for today, I'll go back to my original slides here. The workshop that we're conducting will be in Sydney. It will be on the 5th of July, and we'll be starting at 8:30 a.m. sharp. There will be a full set of colour notes provided. Morning tea will be at 10 o'clock, lunch at 1, afternoon tea at 3, and we'll finish by 5. This webinar today, if you've got questions that you'd like to put in, we'll deal with the questions back to you privately. First Prudential will deal with the questions back to you privately, or we'll take them to the workshop and deal with the questions in the workshop. Workshops are quite important because rather than the webinar type of introduction, because workshops, they're face-to-face, you get to ask the questions, you get to work out, nail out the answers, that type of thing. It will be an extraordinary day. I'm quite pleased and quite excited to present it for First Prudential, and everyone will come away from that day having learned something, and it doesn't matter what level of trader you are or what level of where you are with this or what product you trade, but it will be very technical analysis focused. As I said, we'll deal with the psychology of trading in the first 10 or 15 minutes. We'll nail it flat, very, very simple insight into that, and then get underway looking at building a technical analysis strategy so that you can build a trading plan and then take advantage of the markets themselves, because the markets are in a very, very interesting place where at the moment a lot of people should be having a look back at this, what's going on, particularly in some of the Australian stocks that have moved more than 100% over the last couple of years. So thank you very, very much for coming out today. We'll be doing this again tonight at 7 o'clock. And again, thank you very much. If you have any questions or would like any further information, please contact First Prudential Markets, and I look forward to seeing you on the 5th. We'll see you then.